Imagine you're Tom. You're 58 years old. You've worked at the same manufacturing plant for 30 years. You've paid into Social Security every single paycheck. You pull up your Social Security statement. It says you'll get $2,400 a month when you retire at 65. You've done the math. With your 401k and small pension, you should be okay. But here's what Tom may not realize. The money being collected through payroll taxes, it doesn't sit in a dedicated account waiting for him. Much of it is being directed toward interest payments. Not roads, not schools, not defense, not Social Security benefits. Interest on money the government has already borrowed. In 2025, according to CBO projections, the United States will spend over $1.1 trillion on interest payments alone. That's more than the entire defense budget. Let me put that another way. America now spends more servicing interest on old debt than it spends on national defense. Before we continue, a note: this video is educational content, not financial advice. The data comes from official government sources. The CBO, Treasury, and GAO. Consult a qualified financial professional before making any investment decisions. You've probably heard politicians argue about the national debt. $36 trillion. It's a big, scary number. But here's what they don't tell you. The debt isn't the crisis. The interest on the debt is. Even if we stopped borrowing today, not one more dollar, the interest payments would continue to be a major budget constraint. This isn't a political talking point. This is math. Today, we're going to dissect the interest rate time bomb. How we got here. Why the math is now irreversible. What's about to happen. And what it means for people like Tom. And you. This isn't conspiracy. This is CBO data. Treasury numbers. The government's own math. Let's begin. To understand where we are, we need to understand how we got here. 1980. According to Treasury historical data, the national debt was $900 billion. Less than $1 trillion. Sounds quaint, no? Then came the 1980s. Reagan's tax cuts. The Cold War military buildup. By 1990, the debt had tripled to $3.2 trillion. The 1990s brought a brief reprieve. Clinton and a Republican Congress balanced the budget. For a moment, there were even surpluses. Debt stabilized around $5.6 trillion. Then came the 2000s. Bush's tax cuts. The wars in Iraq and Afghanistan. The 2008 financial crisis. By the time Obama took office, the debt was $10 trillion. The 2010s saw stimulus packages. The Affordable Care Act. Then Trump's tax cuts. By 2020, we were at $27 trillion. Then COVID hit. Trillions more in stimulus. Relief packages. PPP loans. By 2025, $36 trillion. Now here's the important part. Every president, both parties, Republican, Democrat, they all contributed to this number. This isn't about blaming one side. This is about understanding that the system incentivizes borrowing. Why? Because borrowing lets you give voters what they want today, while pushing the bill to the future. The future is now here. But here's what nobody tells you. The debt itself isn't the problem. Countries can carry debt. Japan has debt-to-GDP. Over 260%. The problem is what happens when you have to pay interest on that debt. And when interest rates go up. Like they did in 2022, 2023, 2024. The cost of that debt explodes. Which brings us to the number nobody wants to talk about. $1.1 trillion. That's what America will pay in interest this year. Not next decade. This year, 2025. Let's put that in context. The entire defense budget. Every aircraft carrier. Every soldier's salary. Every missile. Every tank. Every military base around the world. $886 billion. Medicare. Healthcare for 65 million seniors. $848 billion. Interest payments. $1.1 trillion. For the first time in American history, interest payments exceed defense spending. Think about that. The cost of borrowing is now greater than the cost of defending the country. Now follow the money. Based on CBO budget breakdown, when you pay taxes, some of that money goes to 23% to Social Security, 14% to Medicare, 13% to defense, and now 18% to interest. That interest goes to the Federal Reserve, holding $5 trillion in treasuries, foreign governments, China, Japan, the UK, holding $8 trillion, banks and institutions holding $6 trillion, individual investors holding $4 trillion. Every dollar that goes to interest is a dollar that doesn't go to roads, schools, Social Security, or defense. Remember Tom, the guy paying into Social Security for 30 years. His payroll taxes aren't accumulating in a dedicated account for his retirement. They're paying interest to bondholders. It's not a retirement fund. It's a transfer payment. And here's where it gets worse. Much worse. There's a number you haven't heard about. $9 trillion. According to Treasury debt maturity schedules, that's how much U.S. government debt is coming due in 2025. Not new borrowing. Debt that already exists. See, during COVID, the Treasury borrowed trillions at near zero interest rates. 0.5%, 1%, 1.5%. Free money. Basically, those bonds are now maturing. In 2025, over $9 trillion in debt must be refinanced. But here's the problem. Rates aren't 0.5% anymore. They're 4.5%. Let me show you what that means. $9 trillion at 0.5% equals $45 billion in annual interest. $9 trillion at 4.5% equals $405 billion in annual interest. That's $360 billion in additional annual interest costs, just from refinancing debt we already have. This isn't new borrowing. This is the cost of old borrowing coming due at new rates. It's like having a $500,000 mortgage at 2% from 2020. Your payment was comfortable. Then your rate resets to 7%. Same house. Same loan. But now you can barely afford the payment. That's what's happening to America right now. And this happens every year. More debt matures. More refinancing at higher rates. The interest bill grows, even if we balance the budget tomorrow. So what gets cut when interest takes priority? There are only so many dollars. When interest takes more, something else gets less. Economists call this crowding out. I call it feeding the beast before feeding the family. The federal budget is like a pie, and the interest slice is growing. 2015, interest was 6% of the budget. 2020, 8%. 2025, 13%. 2030, projected 18%. 2034, projected 23%. Every percentage point interest takes is a percentage point something else loses. What's being squeezed? Infrastructure. America's roads and bridges are deteriorating. The American Society of Civil Engineers gives us a C-. But where's the money for repairs when interest eats the budget? Education. Federal education funding has been flat for a decade in real terms. Research and development. R&D investment is declining as a percentage of the budget. Defense. The $886 billion sounds massive, but adjusted for inflation, real spending power is declining. And entitlements. The math on Social Security is getting worse every year. Remember Tom, he's counting on Social Security. But every year, more of the budget goes to interest, and less is available for benefits. According to the Social Security Trustees report, the trust fund will be depleted by 2033. Not because people aren't paying in, but because the money is being redirected to feed the interest beast. But can't we just grow our way out? Can't the economy outpace the debt? This is where most people's eyes glaze over. But this is the key. Stay with me. Debt-to-GDP ratio. It sounds technical, but it's simple. How much do you owe compared to how much you make? If you make $100,000 a year and owe $50,000, your debt to income is 50%. That's manageable. If you make $100,000 and owe $150,000, you're in trouble. America's debt to GDP is now 124%. We owe more than we produce in an entire year. Now here's the trap. This is the doom loop. Based on CBO fiscal projections, when your debt is 124% of GDP, and your interest rate is 4.5%, you would need GDP to grow at approximately 5 to 6% just to stabilize the ratio. US GDP growth averages 2 to 3%. So, every year, the ratio gets worse. The debt grows faster than the economy, which means more borrowing, which means more interest, which means more debt. It's like trying to pay off a credit card with another credit card, except the credit limit keeps going up, and so does the minimum payment. This isn't theoretical. History has examples. Greece hit this point in 2010. Debt to GDP over 120%. Interest rates spiked. They lost access to markets. Bailout. Austerity. A lost decade. Youth unemployment hit 50%. Argentina hit this point in 2001. Default. Currency collapse. 25% unemployment. Middle class wiped out overnight. Japan has been in this loop since 1990. Their solution: the central bank owns 50% of government debt. Zero interest rates for 30 years. And they're still stuck in economic stagnation. The math doesn't care about your politics. So what are America's options? There are only 4 ways out of this math. None of them are good. I call this the menu of misery. Option 1. Grow out. Grow GDP faster than debt grows. Would need sustained 5 to 6% growth. The US hasn't done this since the 1960s. With an aging population and slowing productivity, unlikely. Option 2. Inflate out. Print money. Inflate away the debt. This works mathematically. $1 of debt today is easier to pay with inflated dollars tomorrow. But it destroys savers. It erodes purchasing power. We covered this in detail in our video on quantitative easing. It's already happening. Option 3. Austerity. Cut spending dramatically. Raise taxes dramatically. This is what Greece did. It worked eventually. After a lost decade and massive social pain. In America's current political environment, reaching bipartisan consensus on fiscal policy has proven challenging. Option 4. Default. or restructure. Partially default. Tell bondholders they're getting 80 cents on the dollar instead of 100. This would collapse the global financial system. The US dollar is the world's reserve currency. Treasury bonds are the foundation of global finance. A default would be the economic equivalent of a nuclear bomb. So, which option will America choose? Historically, many governments have gravitated toward option 2, allowing inflation to erode debt over time. They don't announce it. They don't vote on it. They just let it happen. The Fed keeps rates lower than inflation. The dollar slowly loses value. Debt becomes more manageable in nominal terms. Savers and fixed-income retirees pay the price. Some economists describe this as a form of indirect taxation. A gradual transfer of purchasing power. The CBO projects this becomes acute between 2028 and 2033. Many analysts suggest the 2025 to 2030 period may be particularly important for financial planning. So, what does this mean for you? This isn't about panic. It's about preparation. What follows are general principles based on economic history, not personalized financial advice. Your situation is unique. Speak with a professional. Let me share 3 principles. Principle 1. Understand the math. The fiscal situation is following a mathematical trajectory. Understanding this context may help you make more informed decisions. Many Americans aren't aware that interest payments now exceed defense spending. Now you are. That awareness is valuable. Principle 2. Consider the nature of promises. Social Security, pensions, government benefits. These are policy commitments that can be modified by future legislation. Historically, benefit programs have sometimes been adjusted. Some financial planners suggest considering scenarios where benefits might be reduced. Principle 3. Consider inflation's historical effects. If the historical pattern holds and inflation remains elevated, certain asset classes have historically provided some protection. Real estate, equities, and commodities have often risen with inflation over long periods. Though past performance doesn't guarantee future results, and all investments carry risk, cash and fixed-rate bonds may lose purchasing power in inflationary environments. This isn't financial advice. It's economic observation. Consult a professional for your specific situation. Remember Tom? After learning about these fiscal dynamics, he decided to review his retirement plan with a financial advisor. He considered whether his timeline and assumptions still made sense given the fiscal environment. He explored options for additional income streams. And he decided to plan conservatively regarding future benefit levels. Tom isn't panicking. He's preparing. This isn't about predicting exactly when or how fiscal pressures will manifest. It's about understanding that the math points in a certain direction and making informed decisions accordingly. Let's bring it back to where we started. America doesn't have a debt problem. It has an interest problem. $36 trillion in debt. $1.1 trillion in annual interest. More than the defense budget. Growing every year. The debt-to-GDP spiral is mathematical. The refinancing cliff is real. The crowding out is happening. This isn't politics. This is arithmetic. Tom didn't panic. He prepared. He adjusted his expectations, diversified his retirement plan, stopped relying on promises that math can't keep. The question isn't whether this will affect you. The question is whether you'll be ready when it does. Remember, this is educational analysis based on publicly available government data. It's not financial advice. Do your own research and consult professionals. If you want to understand how the Fed's money printing contributed to this interest crisis, check out our video on quantitative easing. I'll link it in the description. Hit that subscribe button if you want to see the math before it hits your wallet. I'm the economic realist. The math doesn't care about your politics. Don't let the interest compound against you. I'll see you in the next one.